Hello to everyone listening to our podcast, The Active Investor with SGH. I'm Steve Hiscock, the chair of the company, and it is my pleasure to be your host for today's episode. In today's podcast, we'll be looking at what happened over February 2025 and what it means for the outlook going forward. This podcast is being recorded on Tuesday, the 4th of March, 2025. Joining me today again for our market updates is our Chief Investment Officer, Rob Hogg. Hi, Rob.
Hi, Steve. Good to see you again.
Good to see you. So, Rob, wow. A lot's happened since we last spoke about a month ago, and I'd have to say that the outlook for markets has certainly deteriorated somewhat, partly a result of what's happening in the US, partly about tariffs, partly about other economic factors. Let's start by looking at what happened to the major market indices and their moves over February.
Yeah, thanks, Steve. It was indeed, as you suggest, a pretty action-packed month. We saw most equity markets in lower over the course of the month. For example, the ASX 300 accumulation index, so a key index here, fell by almost 4% over the month, down to 3.8. Small companies did fractionally less bad than that, falling a little bit under 3%. And the US equity market, just looking at the S&P 500, it fell by around 1.5%. The NASDAQ was weaker than that, and small caps also weaker than that. And that was pretty typical right across all those US markets. European markets did better than that. They were mainly in positive territory. And we've spoken about this a little bit before, that sentiment coming into 2025 in regard to Europe and Asia for that matter was very, very negative, whereas sentiment regarding the US was incredibly positive. And perhaps we're just seeing some payback for that, or perhaps there's something else that's more important and underlying, and we'll talk about that. Just quickly, with interest rates, the Reserve Bank here cut rates, as was pretty much expected. That actually didn't have much impact on markets on the day. But broadly, our interest rate markets, so the 3 and the 10-year bond, moved in the same direction as the US market, but US yields fell by much more. The 10-year yield in the US actually fell by a little bit over 30 basis points, whereas our 10-year yield was a little bit over 10 basis points. But broadly in the same direction, but quite a marked move in US bonds over the course of the month.
Right. Thanks, Rob. So let's have a look at the reasons behind the market moves. Perhaps we could start with what's happening in the US, given you referred to the bonds and the equity markets there. Look, as you note in your March update, the rhetoric coming from President Trump has changed. But it's not just the president, it's also the Doge-related job losses. They seem to be starting to show through, perhaps. Give us an insight into what's happened in February on that side and tell us why that impacted equity and bond markets.
Yeah, so this is a feature I guess we really saw concentrated in the US. And it is all really down to Trump and the new administration and Elon Musk as well. And look, it's a lot about volatility, it's a lot about uncertainty, and we'll come back to that in a little bit. But the impact of the uncertainty, I think, about policy has seen equity markets really become a little bit more concerned. That and the fact that economic momentum in the US seems to be slowing a little bit. Now, it's an open question as to how much is being caused by the uncertainty that's increasing in the US, but there is certainly a pretty clear pattern now that activity in the US is starting to ease. Inflation expectations also starting to rise a bit, interestingly enough, and that's probably tariff related. And of course, the Doge related job cuts. We've seen an increase in weekly unemployment claims around the Washington area in particular. Now, some of that could be seasonal. This is not uncommon in the first month or so of the new year. But I think looking from here, the monthly payroll number in the US will get, well, it's always got a lot of focus. It'll get even more focus as analysts try and look through that into the detail to see whether or not the Doge job cuts are really starting to have a significant impact on overall employment.
Yes, and I mean, the fact that the bond market in the US moves so much, as you mentioned just before, I mean, it moved a lot more than the Australian market, so there really potentially is some concern about economic outlook there. I mean, so really this month, the Feb has seen a big increase in uncertainty, not just from investors. I think it's fair to say that we've probably seen an increase in uncertainty from corporates as well. That quite often doesn't bode well for economic growth, does it?
Yeah, no, that's exactly right. There is a group that put together what they call a policy uncertainty index. And that looks at a range of things like newspaper coverage of policy-related mentions of economic uncertainty. It looks at changes in the tax code in the US. And it also looks at the degree of difference amongst economic forecasters. In this case, in a survey put together by one of the regional banks in the United States. This particular index has been rising very sharply. So the way this can impact activity is it really can put off decision making. It can put off investment decision making. It can put off employment decision making, and that can begin to develop its own sort of negative momentum. So that is watching very, very closely. But we also need to balance just how much of this is being reflected in market pricing. So clearly equities have already started to slip away in the United States, negative returns during the month. So that needs to be borne in mind as well, just how much of this uncertainty is already priced or is becoming priced in the market. But there's certainly no question about the fact that the new administration, with its policy announcements, we just had a tariff policy, not so much announcement, but reaffirmation, if you like, just overnight, last night. That is, as we can see, markets really starting to unnerve investors.
Thanks, Rob. So looking at this US economy, there's certainly evidence of slowing momentum. Perhaps you could drill a little bit deeper into some of the indicators and tell us what's out there.
Yeah, Steve. So some of the things that the market's looking at are things like consumer confidence. Now, for the month of Feb, we saw the sharpest monthly decline since the middle of 2021, and a sharp increase by survey participants of things like tariff and trade, comments about the current administration and its policies. But interestingly enough, also much higher inflation expectations. So on a 12-month outlook, consumers in this survey anyway are now expecting inflation of around 6%, up from 5.2%. And that's something we're also seeing reflected in the bond market, particularly amongst the shorter maturity part of the curve, which sort of suggests that as far as the market's concerned, the inflation impact here will be over the short term. We see that reflected in what's called the break-even inflation rate as priced by two-year bonds. And what I mean by that specifically is that using this part of the bond curve, inflation expectations as priced by the market have gone from 2.5% at the end of last year to 3% as at the end of Feb. That is really quite significant. And that has occurred as, in fact, the CPI itself in the United States, so for January, just seems to have really stalled out in its whole disinflation process. And in fact, over the last 3 or 4 months, we've seen an increase in monthly inflation, and now we're starting to see an increase in annual inflation. So this is occurring as the US economy is losing momentum. The Atlanta Fed, what they call a GDP Now estimate, and just looking at the very latest one for the very beginning of this week, that is now moved into negative territory. So this is, on the face of it, a forecast of contraction in the US economy in the first quarter. What the Atlanta Fed use are just a range of different indicators, just common or garden macroeconomic indicators. And that's now the point they've got to. So that's a remarkably swift deterioration in market data, pointing to a slowing in the US.
So, Rob, I think, if you look at it, you've got the spectre of higher inflation and therefore higher interest rates short term. You've got a slowing US economy. You've got increasing tariffs, and obviously the three are not exclusive to, they're all interrelated. I mean, that really that's the main reason for your increased caution, isn't it, in the market?
Yes, it is. It's just not a great composition of factors. So I think for investor confidence and markets to turn around, ideally, you'd see a bit more disinflation. So that's still positive inflation, but at a slower and slower annual pace. So a bit of disinflation, which we're not getting now. We're getting, if anything, a re-acceleration. We also need to see slightly better economic numbers as well, because while we've got this inflation constraint, it makes it very difficult for the US Central Bank, the Federal Reserve, to continue cutting rates. And sure enough, we've seen those rate cuts over the last month or two be priced out a little bit. They're still looking for rate cuts in the US, but the market's now expecting fewer rate cuts than they were so long ago.
Okay, and as we've talked about in the past, it's the change of rate of change that is important. So there's definitely time for some caution on the US. If we look elsewhere in the world, one of the questions you and the team have been asking yourselves recently or since late last year is, and something we talked about in January as well, is whether the Chinese economy is improving. Can you talk about what you're seeing and the potential market impacts?
Yeah, so this really comes from the perspective of just so much negative sentiment on China at the end of last year, as there was on Europe. And look, completely understandable. Of course, we knew before Trump was inaugurated that China was very much in the focus of the new administration for tariffs. And we knew, of course, that Europe was as well. Whereas the market was talking about US exceptionalism, the market was talking about US tax cuts and deregulation. So you really had a very, very, look, I guess bifurcated is one way of thinking about it. Very, very positive views on the US, but very negative views on China and continental Europe. So in that sort of context, you only need slightly less worse data in Europe and China to turn sentiment, or slightly less good data in the United States to turn sentiment. And that's what I think has sort of occurred. But in regard to China specifically, the story there was one where there was an initial boost to the market around the middle of last year on the back of some policy announcements, but they were then followed up by a number of other announcements. None of them really contained significant fiscal spending, which is what the market had been looking for. So that as well contributed to the negativity last year. This year, some of the data's come out better than expected, and of course in the context of very negative sentiment, better than expected and in fact growing. So this is a manufacturing survey produced by the Chinese National Bureau of Stats. That was better than expected and rose back into expansion. So again, in the context of negative sentiment, a number like this that surprises on the upside and points to expansion at a number of 50.2, so above 50, the key expansion contraction level, that is really starting to take the market's attention.
And the market, to use the jargon, the market is short China. It's nowhere near index weight. So as you said all the way along, it's that sort of factor that can influence big spikes in the market. Okay, Rob, thank you for that. On to Australia. You mentioned the Reserve Bank. It cut it as expected, but it's probably fair to say it wasn't all plain sailing over that process. Can you talk us through that?
This is a very interesting sort of episode, I guess, for the RBA. There's almost always arguments either way for what the Reserve Bank should do, whether it's raising rates or cutting rates. And look, in this context, in this particular occasion, that was very much the case as well. Whilst things are trending in the right direction on an inflation on an underlying basis, which is what the Reserve Bank really looks at, the trimmed mean and so on, still not really where it needs to be, but it's moving in that direction. So in that context, what the RBA did, their rate cut of 0.25% down to 4.1% in Feb, whilst completely as expected and almost 100% priced, the Reserve Bank, and particularly the governor, who now has a press conference after rate cut announcements, or indeed after any meeting, went to great lengths to try and talk the market's enthusiasm for a series of further rate cuts to really talk that down. So, for example, the statement said, the RBA statement, as they made the cut, spoke of saying that whilst that policy decision recognises welcome progress on inflation, the board, so that's the board that makes the decision, the board remains cautious on prospects for further policy easing. And indeed went on to say if monetary policy is eased too much, too soon, inflation could stall and inflation would settle above the midpoint of the target range. And look, on the face of it, that's what's been happening in the United States in the last couple of months. So I think that really underlines their caution, but also the fact that the labour market still is performing incredibly powerfully. The Aussie economy is still creating almost 50,000 jobs per month, which I think continues to confound everybody.
And are they mainly full-time or part-time, or what's the mix?
There's been a very good mix. They're still leaning very much towards the full-time side, so the unemployment rate still remains pretty low. There's a measure that we look at, and that's the proportion of the working age population that is either working or unemployed, the participation rate. And that's risen to a record level. So that is actually another sign of just how strong this is. And given the unemployment rate has not risen, even as the participation rate has risen, that just tells you how strong the employment growth has been, because it's been more than enough to employ all of these extra people that are now participating in the Aussie economy. So, and this is obviously fantastic news, but this is one of the key reasons why the RBA will need to be cautious. That, I think, and the fact that some indicators are suggesting that really as we've moved through the March quarter or maybe the end of the December quarter, activity has just started to slightly improve. So if indeed the economy is already starting to pick up steam, that paradoxically is yet another reason why the RBA will be very, very cautious about further rate cuts.
And just reading overnight or yesterday in the markets, the average house prices has started to tick up again, which the Reserve Bank probably did not want to see.
No, indeed, probably did not want to see. So all of these things sort of suggest that really the economy coped better than most really expected, but that was particularly the case for employment. And if indeed house prices are now on a sustainable increase again, this is not really the sort of environment, unless you continue to see significant falls in inflation, so more disinflation. That will be what is required for the RBA to make further cuts and further cautious cuts.
So clearly the interest rate outlook is absolutely critical for us. I mean, what indicators will you be closely following over the next few months? The important data points, what coming up in March that we can have a look at that's likely to influence investor thinking?
Well, look, it'll be the usual list of suspects, and this is the case everywhere. Inflation is almost always the most important indicator, and we now have a monthly inflation time series, whereas we used to be only quarterly, so we'll get another snapshot of that. Employment, as we were just saying, employment's one of the key factors that will determine what the RBA can do, and that's monthly as well. And look, these sentiment indicators, we're always a little bit wary about sentiment, because what people say in surveys is not always what they do, but they can have a leading sort of nature to them. So that's why we do look at things like consumer confidence and corporate confidence measures as well. They're the types of things which is really not a lot different to what we normally look at, but inflation even more so than usual, because that's really the most important indicator and determinant of what the RBA can do.
And from an Australian economic perspective, is it still too early to tell the effect of and the likelihood of tariffs?
I think it is. Well, there's the potential effect on us directly, and that's still very uncertain. But of course, the big issue is the impact on China, and that's almost impossible to know. We don't know what the final tariff regime will be, US vis-a-vis China, nor do we know what the Chinese policy reaction will be. So it is almost impossible to make a judgment about how that will pan out on Australia and China, of course. The only thing we do know is that whilst it is improving slightly, sentiment on China is very, very negative. So again, if the outcome tariff-wise is less than feared, if the policy reaction is greater than expected, those are the kinds of things that somewhat bizarrely could turn it into a slight positive. But we'll have to wait and see.
Okay, we will wait. Thank you, Rob. Another reason February's been so busy is that it's half-yearly company reporting season for companies listed on the stock exchange. I know you're talking to Hamish Tadgell in an upcoming podcast about the reporting season, but in a general sense, how did the team find things? Were there some common themes that they saw?
Yeah, look, there were, and as you say, in another podcast, we'll drill into this in a lot more detail, but really just four things, very sort of high level. The banks have been the key driver of the Aussie equity market for the last year in particular. And one of the key elements that drives bank profitability is the net interest margin. So basically the return that banks receive from the loans they make relative to their cost of funding. And what had been a tailwind during most of 2024 now looks like being more neutral, perhaps negative. Now, they're impacted banks in terms of their cost of funds by what the RBA does. So the rate increase by the RBA will make funding. It's slightly more expensive. And there are signs of a little bit more competition as well, and that may well further increase if this pickup in house prices continues. So that net interest margin tailwind now looks like it's a bit more neutral, perhaps moving into a headwind, and that's pretty important. Victoria was another feature, unfortunately. Many companies spoke about how the Victorian economy is performing significantly worse than most of the rest of Australia. CBA actually had an interesting chart in their investor update where they looked at the proportion of their home loans which were starting to go sour and what proportion of those were actually in Victoria, and that's been rising over the last 18 months, unfortunately. Resources were another key area of focus. Sentiment there's been pretty negative, and that's really this China-related story. So the outlook for China is incredibly important there. And then just finally, outlook statements. We look to these to get a sense from companies about really what their outlook is, and there weren't terribly many heroic outlook statements. So if indeed companies are seeing any sign of green shoots, they're still reluctant to get too excited or to extrapolate those as yet, which in a way is understandable.
Okay. Any standouts in the reporting season? Any winners? I mean, were there some winners, surprises in the reporting season?
Look, there's always a couple. You'll have dotted some of the consumer discretionary stocks doing relatively better. A couple of the banks performed extremely poorly. One of the surprises is more a sort of a market-related thing, and that is that price volatility on result days. Some analysts have estimated we saw average intraday, so within the day swings of up to 7%, which is extraordinarily high. And look, this might be a product of several things: increased passive investment as a proportion of total investment, issues with liquidity. We know that particularly down the smaller cap end, market liquidity is still not as solid or as liquid as has been in years gone past. And it does point perhaps as well to potentially a case of stale earnings estimates. But that was an interesting sort of phenomena of the month, these very significant swings, which is to say that as companies are reporting, the results are surprising more than usual, as evidenced by these significant intraday swings in their share prices. This is possibly, most likely, in fact, a new sort of structural phenomena.
Right. And yeah, you're right. On the passive side, the increased amount of passive just makes any buy and sell order more volatile by virtue of limited liquidity. So given the inexorable rise of passive in a way, it's not likely to go away, that side. So, Rob, wrapping all this up into an outlook then, for some time, in fact, probably for the last 6 to 8 months, we've been talking about being cautiously optimistic, recognising the markets were expensive, but we couldn't really see any imminent clear catalyst that really concerned us. Your tone has changed in the latest monthly. So can you talk about this and why you've changed your stance and what it means for our investors in individually managed portfolios?
There's huge turnover in terms of personnel. And we know there's this volatility. We know, I mean, we've experienced Trump before, and if anything, he's proving possibly more volatile than we all remember. And it's just a bit difficult to imagine that we're going to sail through that completely unscathed. Again, we need to bear in mind just how much of this is priced in, and more of it does seem to be priced in, given that equities have started to move a bit lower over the last month. So what are we doing about it? We tend to be no more than market weight in equities, in some portfolios underweight. We're looking at slight adjustments to the actual underlying portfolio holdings, moving toward less risky, less volatile equity exposures within our equity allocations. We're looking more so at fixed coupon bonds. So these are bonds whose coupons are fixed through time, who, if market interest rates continue to fall, will see an increase in their price. Their duration is such that lower market rates lead to capital gains on the bond prices. And this is moving a little bit away from where we've mainly been weighted in floating rate exposures. So we've just started to do that. We did think that perhaps back July, August might have been the time to do that. We looked at it then. We didn't follow through, and in fact, we saw market yields rise right through the whole Trump re-election and so on and so forth. So it was good that we didn't follow through then, but we're now looking at again. Perhaps the conditions now are a little more conducive to moving slightly more into fixed coupon exposures and slightly lessening those floating rate exposures.
So, Rob, if I had to put it in one sentence, you've moved from cautiously optimistic to basically just cautious.
Yes, basically just cautious.
Brilliant. Thanks, Rob. Thank you so much again for your insights. It sounds like we might be in for a slightly more bumpy road in the short term. And on that basis, we're likely to have lots to talk about in our next episode, which will cover March. That brings us to the end of today's podcast. We looked at what happened in February across the globe and what it means for investors going forward. We hope you enjoyed today's episode. Please subscribe so that you don't miss out on future podcasts, and follow us on LinkedIn, YouTube, Spotify, or Apple Podcasts, and wherever you get your podcasts from. And please do let us know if you have any questions or comments. Until next time, stay informed and stay active. This podcast is produced by SG Hiscock & Company. It does not constitute financial advice and assumes a certain level of knowledge. It is general information only and does not take into account the investment objectives, financial situation, or needs of any person, and should not be considered a recommendation. The views in this podcast are those of the contributors at the time of recording. Neither SG Hiscock, nor any of its related parties provide any warranty of accuracy. Returns are not guaranteed. Please refer to the episode description for the link to the full disclaimers and disclosures.